Okay, good afternoon and welcome to today's webinar on which structure should I choose when I set up my new firm with Paula Wheatley from Charnwood Accountants. For those of you who don't know me, my name is Lucy and I'm an assistant consultant at DG Legal. The slides from today's presentation will be sent over tomorrow, and a recording of the webinar will be available for 3 months. So if we do run over and you need to leave, you'll be able to watch the webinar at another time. However, I think today's might be slightly shorter, and then we'll have time at the end for questions. We are in webinar mode, so we can't hear or see any of you. So please use the Q&A function so that the speaker can answer your questions. So a little introduction of Paula. Paula has been with Charnwood Accountants since 2011 and heads up the solicitors division of the firm. She's a true specialist in advising legal practices on their financial planning, tax efficiency, and compliance with the SRA audit regulations. With her expertise in the sector, combined with working in general practice, Paula has delivered some exceptional results for the legal practices she works with, from succession planning through to fundamental changes in their internal systems, resulting in better staff efficiency and profitability. So over to you, Paula.
Thank you. That was a lovely introduction. So as Lucy said, the webinar will run slightly shorter than I originally anticipated today, so don't worry about running overs in this hot weather at the moment, but I have left plenty of time for questions. So just to give you a little bit about the background of the firm, we've been working with solicitors for quite some time now, and we've got a large number of clients which cover a vast range of the legal sectors. This means that we've developed a really good understanding of the industry and the factors that affect solicitors' practices. I'm one of the partners and head up the solicitors department, and over the years my roles developed from the standard services of completing the audit and preparing the accounts to assisting the cashiers and the practice managers with internal compliance, and now my role actually involves a lot more time spent with the partners of the firms discussing the development of their business and succession planning. So by covering that vast range, I feel that I've really witnessed each area of practice for firms and feel that I can add real value across the whole firm for the clients that I act for. So today's webinar is about the structures that are available to you when you're setting up a firm. So those are the things that I'll be covering, and as I said, I'll leave time at the end for questions. So firstly, let's talk about what types of structures are available to you. So there are 5 ways you can trade your business. First is as a sole trader. This means that a single person is running the business for themselves and their profits are declared annually on their self-assessment tax return. Next, there is a partnership. This is more than one person running the business, and again, all of the profits are declared annually on each person's self-assessment tax return. You then come on to the LLP model, which is the same as a partnership, but it is also registered at Companies House, so it enjoys the same benefits of being a limited company. And then next we have the limited company itself. So this is a business that is registered at Companies House and so attracts limited liability status. Each of the business owners holds the shares in the company, and there can be as many shareholders as you want, and their shareholding can be varied as you wished based on the percentage of the company you would like them to own. Then there's also something called an employee ownership trust, which is known as an EOT. A lot of you might recognise this as the John Lewis model because they've done this with their staff force. It's still a limited company, but it's a slightly different structure, and the difference being here that the staff pool own the shares rather than any one individual or several individuals. This type of structure is becoming more and more popular when it comes to succession planning, as it's a really tax efficient way to sell your business and works for people who can't find a buyer for their business or can't find someone within the management team to buy them out that can fund a large enough loan for the purchase. And we are running a separate model on employee ownership trusts at a later date around succession planning. So if you are interested, please do listen in on that webinar as well. So now I've explained the types of structures, I'll just run through the pros and the cons of each one so that you can understand them a little further. So first up, sole traders and partnerships. Now, essentially, these are the same thing. The only difference between them is whether you are setting up alone or you are setting up with other people. So once you're over that question, everything about them is exactly the same. So let's talk through the benefits. In terms of SRA registration, there is slightly less form filling, but overall the exercise is fairly similar no matter what structure you take. However, the big difference comes from an accountancy perspective. You don't need to spend time registering a company's house and then registering the company and all of the individuals with HMRC. Instead, you register as self-employed with HMRC once you begin to trade, and it's a one-page form. So very, very simple. There is also less ongoing compliance to consider as a sole trader or a partnership, because you don't have to meet the filing deadlines imposed by a company's house. And the accounts themselves are much more simple to prepare, which means you keep your accountancy fees quite low. Additionally, company accounts must be made available on public record, along with the names of the owners of the business. But as a sole trader or a partnership, you don't have to do this at all. Instead, the only people that see your figures is HMRC, which means you maintain maximum privacy. Then we come on to talking about tax losses. So in the early years of trading, many firms, whether they're solicitors, practices or not, will make a loss. And that's just through the setup of the business phase and trying to bring on your client base. As a sole trader or a partnership, these losses can be offset against your prior tax paid for up to 4 years. So if I give you an example to help you understand this further, if you were employed and you earned £100,000 salary, you would have paid approximately £27,000 in tax. Then you decide to set up as a sole practitioner, solicitor, and run your own business. In the first year of trading, you make a loss of £50,000. Now that loss can be carried back and offset against that 100k salary. So then effectively your salary becomes a 50k salary and therefore results in a tax refund of £20,000. Now with a company, this isn't available because that company has no past income and it's an entity by itself. So therefore you have no way of relieving those losses. They have to be carried forward for future profits. The downside, unfortunately, to operating in this structure is that all the risk is on you. So if your business goes under, then you are personally liable, and there is a potential that you could be made bankrupt as a result, depending on how poorly the business is performed. Additionally, irrespective of whether you draw the cash or leave the cash in your business current account, you're still going to be taxed on those profits, which is a little irritating for you, because if you've made lots and lots of money and you're being taxed on it all up front, you might be thinking, well, I'm never going to spend that money. I set it aside for use in the business. It doesn't matter as a sole trader or partnership. It is taxed on your tax return as you make those profits. Okay, so then let's move on to talking about limited companies in a bit more detail then. So having limited liability status means that the company is an entity in its own right. So assuming no fraud has taken place, limited liability means that you are not to be personally liable for any financial losses made by the business. A limited company can give you the added protection should things go wrong, which you don't experience with a sole trader or a partnership, because as I said, you are the entity. So if it goes wrong, it comes back on you. Next, the professional status and image will provide considerably more for you as a trading as a limited company. Whilst the activities and the ownership structure and the internal management of the business are all the same, when you're operating as a sole trader, you're just not quite regarded in the same way. So it creates a better impression by being a limited company, is the perception that's out there, whether it be true or not. Limited companies can come across bigger than they actually are, making them appear professional. So it means that a limited company is more likely to attract clients and investors than the other business structures would. It might even be easier for a limited company director to get funding, such as a loan from a bank, as they're seen as a secure business. When a business is set up as a sole trader, the business is not officially registered with Companies House as well. So whilst the processes of being a sole trader are easier, you don't have that protection for your name that you do with a limited company, because it's not trademarked. So when you register as a company, it's registered at Companies House and your company name is automatically trademarked, so it's completely unique to you. This can make it easy for you to appear as a very individual business and also enable you to be found more easily online. Okay, so next up I'll explain limited liability partnerships, which a limited liability partnership known as an LLP is actually a hybrid entity which adopts many characteristics of a partnership and a company. So as I've already mentioned, a partnership is not a separate legal entity. So in other words, a partner is a collection of individuals working together in business with a view to make a profit. An LLP, on the other hand, is a separate legal entity distinct from its members. And when I say members, really what we're saying here is they're the partners, but in an LLP, they call them members. So an LLP must be registered at Companies House in the same way as a company. Therefore, the level of regulation for a partnership is minimal compared to an LLP. And an LLP follows the same statutory requirements as a company, which includes the requirement to prepare and file annual accounts. Partnerships aren't subject to these obligations, so instead you prepare a partnership tax return. So you may be thinking, well, why would I bother one over the other? Well, the perk of an LLP is the fact that the members of the LLP enjoy that limited liability status. So up to the amount of any financial contribution they make, that is the limit of their liability, which mirrors the situation of shareholders in a company. In a partnership, the situation is different because the partners are jointly and severally liable for the debts and obligations that the partnership incurs whilst he or she is a partner at that time. And scarily as well, those liabilities are potentially unlimited. So the difference there makes an LLP seem a much more attractive option for people. The partnership and the LLP carry similarities as well in that the tax treatment of them is both the same. So for tax purposes, an LLP is treated as a partnership and therefore the members are taxed as self-employed, much in the same way as partners in a partnership are taxed as self-employed. One thing you may have spotted is that a lot of firms are set up as a partnership or an LLP, but actually their members are corporate, so they're limited companies. In the past, this has been a really popular model because it's enabled substantial tax savings. However, in 2019, when the new solicitors accounts rules came out, the SRA removed the ability to have corporate members as the partners of the LLP or partnership. So what that means now is that there's a lot of firms that have got that structure at the moment are struggling to admit new partners if they want to keep that same structure going on. So therefore they're having to reconsider what status they want to be going forward, and some are considering full incorporation into limited companies. So now I want to move on to talk about the tax savings so that you can understand how you're affected in each structure. So first of all, there's the self-employed, which is covering your self-employed people and partnerships and the members of your LLPs where they're members of individuals. So as a self-employed person, you move through the tax bands as you earn your profits. So the first £12,570 is known as the personal allowance, and this is taxed at 0%. Then you've got the next £37,500 is taxed at 20%, and this is known as your basic rate band. After your basic rate band, you're in the higher rate tax band, which is 40%. And you stay there until you hit £150,000 of income, and then you're taxed at 45% on any profits over and above this. In addition to that, once you go over 100k, you stop losing that 12 grand personal allowance as well, which is a really high effective tax rate on that loss. And then on top of that as well, you pay national insurance at 9%, and then this reduces to 2% after 50k of profits. One thing to note is, as a self-employed person, once you are taxed on those profits, what is left is automatically yours to spend as you wish. So by comparison, then, a limited company, all of the profits are taxed at a flat rate of 19%, although please note that this is actually going up to 25% from 2023, in line with the budget that was recently announced by government. So you're probably thinking to yourself, well, if self-employed people are paying 45% tax plus NI and companies are only paying a flat rate of 19%, I'll just set up a company because it's cheaper in terms of tax. But unfortunately, it's not quite that simple. So you'll notice I've got a third diagram which says dividend tax. So where a company's profits are taxed, the company pays the tax, but then those profits remain in the company as it's its own entity. Now, the shareholders are allowed to draw a dividend, and that is how you get those profits out of the company. But as they draw that dividend, they are taxed on it personally as it is extracted. So the dividend tax rates are the first £14,570 is at 0%, because that covers your personal allowance that self-employed people also get, plus this 2,000 dividend allowance, which is at 0%. Then the remaining of the basic rate tax band, which is 35k, is taxed at 7.5%. And then after that, it's 32.5% up to your 150,000, and then it goes up to 38.1%. So what does that actually mean for you? Well, especially with the new corporation tax rates of 25% coming in, the tax savings on being a limited company, when you add together the company tax and the dividend tax, are actually really quite negligible when profits are low. So you could potentially just stay as self-employed or a partnership. The only time you'll really feel a benefit of being a limited company is if you make really large profits, but you don't actually need to draw all of them out of the company to live on. So your dividend tax figure is much lower. Now, I appreciate that's probably a bit mind-blowing number science, so I've put some numbers to it to give you an example, just to make it make a bit more sense. So I've got a self-employed person who's made £200,000 of profits. So the tax and national insurance on that will be £81,000. And after they've paid that, they have cash in their pocket of £118,000. So by way of comparison, a limited company has made the same level of profit, £200,000. The corporation tax, which is at 19% on that, will be £36,000. The person that's running this company is then choosing to take a small salary and dividend up to the value of £100,000. And the tax on that dividend personally for them is £18,000. So the difference here being that you've paid £54,000 in tax on your company as opposed to £81,000 being self-employed. But you'll note your cash in your pocket is actually only 81k. And that's happened because you've got that undrawn profit of £63,000 that you've left in your company. So where I get £63,000 from is the 200k minus the tax of 36 minus the 100k you've taken as a dividend. That leaves 63 grand in the company. So the benefit of leaving that money in the company allows you to draw it down at a later date. You will always be taxed on it personally, but if you do leave it in the company to build up over a longer period of time, there are other ways you can deal with it. So for instance, at the point you sell your business or the point the business is winding down, so actually you're generating less profit to be able to take, you might be able to benefit from lower tax rates. So overall, the point I'm making is, unless you have very high profits but need very low levels of cash right now, then the benefit of being a company over self-employed isn't that great. Now, with what I've just said, I just want to add a comment to it really to say, don't forget. And while I appreciate the attraction of a limited company is due to the limited liability status that you don't feel the benefit of if you're a self-employed person, it's just a reminder that really, if you're unsure about which model to take, it's very much easier to start out as a sole trader or a partnership and then incorporate at a later date. It does mean more compliance in terms of the SRA form filling exercise, But the point being is, if you start as a company and then decide that's not right for you and want to disincorporate, that is a much more difficult task to undertake. So that's why you should start sole trader and move to company as your method. Then you need to factor in succession planning when you're deciding on your structure. Now, one main thing that we talk about with every single business that we act for is start with the end in mind, because what's the point in starting a business up if you don't know where it's going? So if you're setting up a firm that's only ever going to be just you, and you just want to make your profits, sit happily on those profits, and then wind down slowly over a period of time, then it doesn't overly matter which structure you decide to choose, because you've only got yourself to worry about. However, if you would like to grow your firm and bring in new partners, then it's much easier to set up as a partnership or an LLP. And that's why you might notice historically that many professional firms, not just solicitors, but other practices of a professional nature, are all set up as partnerships. The reason for this is that the profits and the assets of the firm belong to the partners in their own right already. So if they walk away, that's fine. Whereas as a limited company, it's a separate entity, which means the company owns the profits and it owns the assets and it owns the liabilities until the point that those things are distributed to the shareholders. So what that means is actually a company is building value over time, because you're not necessarily distributing everything that's owned. And when you then bring in a new shareholder to the firm, where you're wanting to give them a piece of the pie for the work that they're doing, what you're actually doing is giving away some of the value that you've created, and that has a tax consequence. And so that's why it makes it much more difficult to do with a company than it is as a partnership. That said, firms are actually finding it increasingly difficult to find successors these days, which can leave you with a really well-established business and a reputable firm at that, with no one to actually pass it on to. So there are more options available now, which is where I mentioned earlier, creating the employee ownership trust. This actually does require a limited company structure, but you can do that at a later date. So you could start out self-employed or partnership, and then if you decide to become an employee ownership trust, you could incorporate and then implement the EOT. So overall, I'm saying it's still better to start the early days as a sole trader or partnership. And as I have also already mentioned, if you do want to know more about employee ownership trusts, we are running a separate webinar on this at a later date. So you might be completely baffled now and thinking, so after all that, Paula, which structure should I actually choose? So put simply, every single client has its own individual decisions to make. But speaking very generally, the way now to go would be to start as a sole trader or a partnership or even an LLP, especially if you're considering bringing in new partners, because the model keeps things simple if you're in that structure. You can always incorporate at a later date, but with the corporation tax rates going up to 25%, there'll be very little in the way of tax savings to be made. So this shouldn't be your main reason for incorporating. There are benefits of limited liability status if you trade as an LLP or a company. But with the fact that you're all solicitors, most of you operate client accounts. So in actual fact, you do have to ensure you remain profitable and have good cash flow anyway, in order to comply with the SRA regulation. So therefore, the limited liability status for the potential risk that the business might go under actually becomes less of a factor, because you're meeting the SRA regulations already. And then when you come to nearing the end of your time working in your business and you're considering leaving the firm and allowing the next generation to take over, you might consider the next step to be the employee ownership trust or onward sale, at which case you'd need to reconsider your structure then, and a limited company may be more preferential at that point. But you need to choose a structure that fits with the appropriate tax rates at the time. So at the moment, entrepreneurs relief is in place, and that's the cheapest form of tax in terms of capital taxes for when you're selling a business. But overall, really, the answer needs to be, you've got to speak to your accountant about it, because every situation is different, and you could have different needs in the longer term than you're thinking of right now. An accountant would be able to advise of that for you. And you should have regular conversations with your accountant about this, because you're not going to stay exactly the same for the whole duration of your firm. Things will change. So you always need to be reviewing this structure on an ongoing basis to make sure it does actually work for you. So I hope that covers it. I understand it's quite a complicated area, and I've tried to keep it as brief as possible just to give you an idea of what's available. So the point really is not to give you an answer of yes, I should go off and be this structure, but more to give you the ammunition to understand which ones will work for you and then decide from there. So that's it from me. It's just, do you have any questions at this point? My Q&A box isn't actually showing, so just bear with me one moment while I bring that up. Okay, so there's no questions coming at this stage, but I've thought of a few. Oh, sorry, one has just come through. Could you expand on the automatic trademark of a limited company, please? Yeah, so basically, when you register a company at Companies House, before you can do it, you have to go and check whether anybody else already has that name. And Companies House are really strict. So if there's something that's even remotely similar, they will tell you you're not allowed that name, and your application to set that company up would be automatically rejected. So that's the protection that is provided by Companies House and having that status. They're also really funny about certain words that you put into your company name, such as, like, if you're calling yourself global or something like that, they might come back with a few queries on the name that you've chosen. So you just have to be careful with that. Okay. So I've got a question that you might all be thinking, but not necessarily thinking out loud at this moment. If you start as a sole trader, for instance, do you actually need an accountant? Well, the answer to that would be, actually, you don't ever need an accountant if you don't want one. Everything, including company accounts, you can prepare yourself online. HMRC give you the tools to complete a self-assessment tax return, and also Companies House give you the tools to prepare a company set of accounts. So you could do everything yourself and keep your costs as low as you possibly could. Would I recommend it? No, because we're the experts in this area, just like you're the experts in all things legal, and there would be inevitably tax efficiencies that you are not making the most of that would enable you to bring your tax liabilities right down, that only an accountant would be able to help you with. Also, you have to consider the time and effort involved in doing these things. Is it worth your time, or could you just pay somebody else to do it for you and get it right first time? And you also have to consider the future things of, what if HMRC did an investigation? Would you be equipped to help answer the queries that HMRC are putting to you? Or would it be easier if an accountant did that for you? It's just food for thought, really. It doesn't appear that I've got any other questions at this phase. Oh, somebody's just popped one through. Do you need all employees to participate in the EOT, which is the Employee Ownership Trust, and can different employees be given different types of shares? Yes and no is the answer to that question. So when you move into an employee ownership trust, you must transfer at least 51% of the shares into it in order for it to be considered an EOT. So what you could do is, say, for instance, you had two people that didn't want to leave and they were shareholders, they could between them retain 49%, and then you could put 51% into the EOT. It has to be 51% in order for you to get that the proceeds of the sale for tax-free, because that's the benefit of an EOT at this stage. In terms of all of the employees participating, well, that's not really the key to it. The staff are considered as a pool. So it's a case of, if you create it, they fall within that pool anyway. So if an employee left, they can't leave and say, well, I'm entitled to 1% of the shares, so I'm going to take those with me. No, that's it. It's for the pool of staff. So if they walk away and somebody else joins, they've left the pool and the new person's in that pool, and they will benefit from the dividends from those shares. Hope that answers your question okay, but if you do have any others, please do follow up with me, because we're doing a lot of work with the OTs at the moment. Do we have any more questions coming through?
I think there are some questions in the chat box, Paula. If you go on.
Oh, is there?
Yeah.
Sorry, I didn't realise that.
It's all right.
I'm not seeing the chat box on mine. Do you want to shout them out to me? Would that be easier?
Yeah, of course. So that's okay. The first one is, with the new SRA changes, would the freelance solicitor setup be the same as a sole trader?
Yeah, so as a freelancer, you can be a sole trader or a limited company. You've just got to find out what works for you. And you might find that actually, because of the tax savings that are being lost now through the higher corporation tax rates, that it's easier just to be a sole trader.
Thank you. And the next one is from Jenny Fraser. Oh, no, sorry. Nick Maguire. Can you use a postal address to register as a sole practitioner instead of using your home address?
As a sole practitioner, the address will be wherever your business trades from. So you don't really have a choice over that unless you set up like a PO box, I think is what you're saying there. So that's possible. As a limited company, you can set up something called a service address. So say you've got an office and you trade from there, and then you've got the directors. Normally, the old way would have been that the directors' home addresses would be on public record. But Companies House have recognised the flaw in that, and so now they've allowed service addresses. So you can make your director's service address your limited company address if it had an office, for instance, or some people do it as their accountants, as their registered office.
Thank you. And the last one is from Adam. How can you do a solicitor's accounts rules audit without an accountant?
You can't do that bit. You can do the accounts on your own, but the audit has to be done by an accountant that's regulated to be able to complete them for you. And most of the time, you just pass the whole lot to the accountant. But a lot of firms aren't operating client accounts now because of how the rules have changed. So there'll be more and more that do have that consideration. They'd be able to not have an accountant at all if they really wanted to.
Well, I think that's it from the chat function.
Brilliant, thank you. Okay, so then just to conclude from our point of view then, thank you all for listening. As Lucy said, the slides are being sent around. Just to let you know our offering, we provide all potential clients a free 1-hour meeting so we can talk about how we can help your firm. So if you're interested in that, please do drop me a line and I'll be happy to have a chat with you. But other than that, thank you very much for listening, and I hope you enjoy the rest of your day.
Thank you so much, Paula, for presenting and answering those questions. And thank you, everyone, for joining. Like Paula said, the slides will be sent over tomorrow, and a recording of the webinar as well. This afternoon, you should receive an email asking us to rate this webinar out of 5 stars. So if you have enjoyed, please do leave feedback, and we welcome any suggestions for future topics as well. And lastly, our series of webinars continues on the 2nd of August. Where we will be presenting on British nationality law with Sean L. from Garden Court, North Chambers. And that just leaves me to say thank you for watching, and have a lovely afternoon.